Earnings have been beating estimates, and that's not surprising. Again, we've lowered those estimates so much that companies are easily beating those earnings. But interestingly enough, companies really aren't being rewarded all that much for beating estimates. Here's what you need to know before the bell this morning. We're right in the middle of earnings season still. Lots of earnings still coming out. We're going to have Starbucks today, Pfizer, Merck, lots of big companies all reporting this week. We've also still got Apple coming, so we're going to hear from them as well. Earnings have been beating estimates, and that's not surprising. Again, we've lowered those estimates so much that companies are easily beating those earnings. But interestingly enough, companies really aren't being rewarded all that much for beating estimates. And the one thing to really pay attention to is not what happens at the bottom line of these earnings statements, right? That EPS report. Don't pay so much attention to that as we just wrote about on our website, realinvestmentadvice.com. We just wrote a report on the tools that companies use to beat bottom line estimates, but pay attention to what's happening at the top line. The number of companies actually beating top line revenue numbers is actually falling. So as we keep expecting all of this to improve, the economy is getting stronger, companies should be doing better, but they're missing those top line sales numbers. The sales numbers aren't really there, so we're making up the bottom line of that through share buybacks, accounting manipulations, etc. Nothing illegal about that. I'm not saying anything about that at all, but this is how we beat those earnings numbers. But yes, we've lowered that bar. Companies are beating those estimates. Markets have been holding up because of that. And again, as we move into the month of August, we have this combination of two things as we're going to hit this month. First of all, earnings will start to go behind us, right? We'll have the earnings season behind us, so that bid under stocks of companies reporting earnings, beating estimates, those type of things, that bid is going to go away. The other part of this is going to come back to just the reality that sentiment is now extremely bullish. And again, markets are very extended, as we talked about yesterday, are very extended from these longer term moving averages. So getting a correction of 3 to 5% over the course of this month certainly won't be surprising. And this morning we're kind of waking up to the first day of a new month. So traders were kind of positioned a bit. Yesterday we saw a very interesting uptick right in the last 15 minutes of the day yesterday, put the indexes into positive territory yesterday. But again, most of that positioning into the month has been done. We may get a little bit of selling here, just kind of rebalancing of portfolios, those type of things. And again, there's been a lot of exuberance in stocks. So for a lot of managers, we've really kind of pushed out there to a fairly large degree. Short covering has been a big driver of this market. The more that markets have risen, the more these kind of bearish managers and managers have been really short the market with the expectation that we're still in a bear market. They're just basically throwing in the towel now. In fact, a really good article on Bloomberg talking just about that these bearish managers have now just capitulated and are having to cover their shorts. And we've seen the most shorted stocks as of late having some of the biggest rallies. So again, it's just that overall kind of negative sentiment reversal that's been pushing the markets, as all that negative sentiment's been pushed back into positive sentiment. And that's what the article is about today on the website. That's been driving the market. The problem, or I shouldn't say the problem, but the issue with that is that we are now approaching kind of that point to where now everybody is back in the pool. So when we get to those levels, we have extremely cheap puts, nobody wants to buy a put to hedge their portfolio, extreme optimism on the markets. That's typically a really good setup for that correction that we've been talking about. So as you kind of look at your portfolio, if you have positions that are really, really overbought, stretched, you've made good money with them, maybe they're overweight in your portfolio, think about just kind of trimming those back to portfolio weights, reducing some of your equity exposure in areas that is more risky, because probably if we do get this correction, those are the areas that are going to get impacted the most. The areas that will get impacted the least during a correction and may actually benefit are some of these out of favor sectors that we've been talking about. Real estate, utilities, those areas, kind of the more defensive areas, may actually pick up some money flows during a rotation in the markets. But just something to kind of pay attention to. But that's what you need to know before the bell this morning.